The elevator dinged. Maria froze. Her hands clutched the railing of the apartment building the stairwell. Outside, a siren wavered, echoing off concrete walls. The smell of gasoline and street food mixed, sharp and pungent. She glanced down at her Renault, parked neatly in the lot she'd bought with a loan 18 months ago. Clean, polished, worthless. The phone buzzed. Bank alert. Withdrawal limit reached, 250 pesos per week. She stared at the screen, squinting through the flicker of the fluorescent light above. A loaf of bread had doubled in price since yesterday. No one said this would happen. Inside her apartment, the furniture gleamed. Electronics humming. The home theater system she bought in installments sat silent, a reminder of predictability. Yet outside, chaos threaded the streets. Pots clanging, people shouting, police tear gas cracking in the air. She sank onto the sofa, fingers tapping the armrest. Eyes fixed on nothing. A calendar on the wall flapped slightly in the draft from the open window. December 1st, 2001. Corralito. A word she would memorize, never forget. Everything she had been taught, responsible purchases, careful savings, the middle-class blueprint for stability, collapsed in silence, not fire. The walls still stood. The air smelled the same, yet the world had shifted, and she was inside it. Questions formed, jagged, unspoken. How do you live when the value of everything you own vanishes overnight? And more importantly, can anyone survive it intact? This section sets the tone, suspense, and immediate empathy. It's sensory, uneven, and grounded in a specific moment. The streets outside her window were quiet now, but the quiet was deceptive. Shelves stripped bare, lines at bakeries snaking for blocks, a police whistle shrill in the distance. 5 presidents in 11 days. Nobody explained it. Not her parents, not her professors, not the financial advisor who had assured her that her savings were safe. The peso, once pegged to the US dollar, fractured. Within weeks, its value plunged roughly 70%. The math behind her life, the calculations she had trusted for decades, dissolved like sugar in coffee. Her apartment still gleamed. The car still ran. The vacation property outside Mendoza, still hers. But in the new reality, all of it was just objects. Objects that could no longer shield her from collapse. This wasn't Argentina alone. Germany 1923, hyperinflation, marks worth less than bread. Japan 1991, real estate prices that made the Imperial Palace grounds worth more than California. Greece 2010, homes frozen, taxes rising, buyers vanished. Venezuela 2016, cars idling in driveways, fuel gone, tires unaffordable. Lebanon 2019, dollar deposits locked, evaporating in a blink. Collapse doesn't always roar. Sometimes it whispers. Administrative, bureaucratic. Price signals break. Banks exist but deny access. Houses stand but can't sell. Cars drive but fuel costs more than wages. Money remains but it buys nothing. And the victims? Not the reckless gamblers, not the speculators. The obedient, the middle class who followed the rules, invested responsibly, and trusted the promises of a stable system. Every purchase made for stability, homes, cars, insurance, education, consumer goods, was a bet on permanence. And permanence never lasts. Maria rubbed her temples. The apartment smelled faintly of polished wood and waxed floors. Outside, distant shouting echoed. She realized something almost nobody ever tells you. The very things that are supposed to protect you are often the first to fail when the system itself fails. This section sets the broader pattern, links Maria's personal experience to historical precedents, and introduces the central thesis. Collapse destroys middle-class assumptions systematically. 1. Real estate, the illusion of permanence. Maria's fingers traced the edge of her vacation home's polished countertop. The paint smelled faintly of fresh solvent, masking the dusty hum of neglect outside. She had bought it in 1998, believing it would appreciate. By 2003, it had lost roughly 60% of its dollar-denominated value. No buyers, maintenance costs rising, taxes piling up, a financial coffin. This pattern repeats. Japan, 1991. Asset inflation peaked. Ordinary families mortgaged modest apartments with 100-year loans. Land always goes up, they were told. 30 years later, some areas still 70 to 80% below peak. U.S. in 2008. House values doubled in Phoenix, Las Vegas, Florida. Adjustable rate mortgages, second homes for investment. Then prices collapsed, 40, 50, 60%, 10 million foreclosures. Families crushed not for recklessness, but for following the rules. Greece post-2010 sovereign debt crisis. Homes froze in the market. Rising property taxes. Income collapsing. The asset became a trap. Real estate's uselessness comes not from bricks or land failing, but from the collapse of the financial architecture around it. Income, credit, market liquidity, and tax structures. Ownership becomes a liability the moment the system shifts. 2. Automobiles, metal stranded in space. She stared at her Renault. Tires inflated, engine silent. 2 tons of metal. Useless, fuel scarce, spare parts unavailable, insurance worthless, roads deteriorating. She still owed the loan. Venezuela 2016. Inflation over 800% annually. Cars idled in driveways. Functioning, but inoperative. Cuba, early 1990s, post-Soviet collapse. Soviet-era cars, impossible to maintain once supply chains vanished. Vehicles that were once symbols of stability became yard ornaments. Mechanism. A car is a node in a network. Fuel, parts, insurance, roads, all inputs in decline during systemic collapse. Remove them, and the asset dies. Ironically, the worst losses fall on those who purchased new cars on credit. Old, fully paid cars lose little. The debt remains, the utility evaporates. The gap between what you owe and what you can use is the middle class's death trap. 3. Long-term financial products, life insurance, pensions, retirement accounts. Maria opened a folder. Life insurance paid out face value. Enough to buy 2 weeks of groceries. The contract honored. Value? Vapor. Historical precedent. Germany, 1923. Marx hyperinflated. A life insurance policy that could buy a house in 1914? Worth less than a loaf of bread 9 years later. Pensions paid, but food unaffordable. Argentina, 2008. Private pension funds nationalized. Promises remained. Purchasing power vanished. Lebanon, 2019. Dollar deposits locked, inaccessible. Mechanism. Promises are only as strong as the system they depend on. Currency stability, solvency of institutions, consistent regulations, functional governments. Every assumption collapses simultaneously during systemic breakdowns. The responsible, the planners, those who trusted institutions most, lose first. 4. University degrees. Knowledge as currency of a dead market. Maria's degree from the University de Buenos Aires hung framed on the wall. Crisp, clean, meaningless. She couldn't find accounting work. Export company admin paid a third of her pre-crisis salary. Soviet Union, 1991. Engineers, scientists, doctors. Degrees once guaranteed placement. Factories closed. Enterprises privatized, gutted. Credentials became keys to locks that no longer existed. Greece post-2010. Youth unemployment, 60%. Spain, post-2008. Degrees in law, finance, architecture, unused in collapsed economy. Generation perdida. Families bore debt. Skills exported. The country paid, but reaped nothing. Mechanism. A degree is a signal, not knowledge itself. Value exists only if the labor market recognizes it. Collapse shatters the market. Debt remains. Opportunities vanish. Credentials are paper anchors in a world that no longer pays for them. 5. Consumer goods. Lifestyle purchases and the illusion of stability. Maria sat amid her home theater system, designer sofa, electronics, clothes, polished furniture. Clean, functional, dead. Zimbabwe, 2008. Hyperinflation skyrocketed, 79 billion% per month. People spent immediately. Anything physical held value better than currency. Appliances broke. No technicians. Clothes wore out. No replacements. Goods consumed. Residual value? Zero. Lebanon, post-2019. Beirut middle class. Heavy consumers. Credit card debt. Installments. Currency devalued. Salaries gutted. Goods became anchors. tying people to liabilities rather than providing utility. Mechanism: consumer purchases in a stable economy signal status, progress, and stability. In collapse, they become weight, obligations, and reminders of lost purchasing power. Physical objects cannot substitute for liquidity, adaptability, or survival. Credit amplifies the damage. Synthesis of the 5 categories. Step back: real estate, automobiles, long-term financial products, degrees, consumer goods. They are the 5 pillars of middle-class identity, the purchases that define responsible, successful life. Buy a home, get a car, invest in insurance, earn a degree, furnish your life. And they fail in a pattern, every time, everywhere. The middle class is fully invested in the formal economy. Wealth tied to assets dependent on the system. Mobility dependent on vehicles and fuel. Security tied to institutions. Future dependent on labor market and education. Identity tied to consumption. Collapse snaps all threads. Wealth evaporates. Flexibility disappears. Survival becomes immediate. The rich, structured to survive systemic failure. The poor, hardly invested, lose little. The middle class, destroyed mechanically, surgically, by the very purchases they were encouraged to make. Each purchase is a bet on stability. Currency, institutions, labor market, government policies. Individually rational, collectively lethal. History is mercilessly consistent. This section delivers full analysis of mechanisms, examples, cause to effect to operational insight. It's cinematic, uneven, and grounded in sensory and human experience, not abstract theory. Look closely. Argentina, 2001. Corralito, peso pegged, then collapsed. Banks frozen, middle class stranded. Venezuela, 2016. Inflation exploding, cars useless, salaries evaporating. Germany, 1923. Marks hyperinflated, pensions worthless. Japan, 1991. Homes mortgaged for decades, values never recovered. Lebanon, 2019. Dollar deposits frozen, life savings inaccessible. Greece, 2010. Degrees in property trapped, youth unemployment sky high. The details differ. The currency, the asset, the mechanism, but the pattern repeats. Always the same victims. The middle class, the obedient, the planners. Always the same culprits. Systemic instability, broken institutions, currency debasement, frozen markets. Always the same outcome. Assets that were supposed to protect, now useless. Notice the contrast. The wealthy, diversified, often international, insulated. The poor, already outside the formal system, flexible, less exposed. The middle class, everything invested in what the system promised. Everything leveraged, borrowed, dependent. A structural trap. The geography doesn't matter. Argentina, Europe, Asia, Africa, the Middle East. The mechanisms are identical. Hyperinflation, credit freezes, asset illiquidity, collapsing labor markets, rising taxes and costs. The middle class pays every time. Even the timeline doesn't matter. Weeks in Argentina, years in Japan, decades in Germany. The speed varies, but the trajectory is the same. Obedience and trust, once rewarded, become vulnerabilities. Everything learned about smart financial behavior becomes a blueprint for loss. And the lesson echoes. Collapse is mechanical, not random. Not chaotic, but systematically cruel. The patterns are visible in history. They don't change because the country is rich, educated, or culturally advanced. Switzerland-level banking or U.S. Federal Reserve sophistication cannot immunize the middle class from the same structural failures if the system itself fractures. Maria could look back now and see it clearly. The trap isn't luck, it's design. Predictable, repeated, and most dangerously, invisible until you're inside it. This section links multiple countries, periods, and collapses, making the pattern of middle-class vulnerability obvious and inevitable. Maria moved through her apartment, lightly tapping the edge of the countertop. Fingers lingered on polished wood, then drifted to the windowsill. She could see the city beyond. The same streets, same buildings, but nothing was the same. Everything she had relied on, purchased to secure a middle-class life, had been tested and failed. The first lesson is liquidity. Cash on hand, easily accessible, in forms that don't depend on institutions, currencies, or markets. Flexibility matters more than assets. A home, a car, a stock, a pension, they're useless if you can't turn them into essentials when the system falters. The second lesson, avoid concentration. Don't pile wealth, credit, or identity into one asset class, one currency, or one country. Collapse hits where dependency is highest. Diversify, not for growth alone, but for survival. Third, maintain optionality. Mobility, adaptability, and the ability to pivot are survival tools. A middle-class life built on rigid plans, long-term loans, and fixed investments leaves no room to maneuver. The survivors always had doors they could open, paths they could follow. Fourth, distinguish consumption from resilience. Luxury goods, status symbols, and lifestyle items are anchors in a collapse. They weigh you down. Essentials, food, transport, networks, knowledge, retain utility. Finally, acknowledge uncertainty. Every financial promise, every credit agreement, every asset assumes systemic stability. History proves it's never guaranteed. Awareness of this fact, without panic, without fatalism, changes decisions. You see bets for what they are. You structure exposure, not blindly follow advice. Maria understood now. Not every collapse could be predicted. Not every asset failure prevented. But awareness, liquidity, diversification, optionality, and clear distinction between consumption and resilience, these were the levers that let someone survive intact when the world around them failed. This section emphasizes actionable principles, keeps the storytelling alive, and avoids giving direct financial advice, focusing on risk awareness, asset management, and systemic thinking. Maria stood by the window. The city smelled the same, yet everything had shifted. The apartment still held her possessions, the car still sat in the driveway, her degree still hung on the wall. And yet the value of each was measured not in pesos or dollars, but in resilience, adaptability, in the systems they relied on. History repeats. Argentina, Germany, Japan, Venezuela, Lebanon, decades, continents, crises. The middle class, obedient and prudent, bears the brunt. The wealthy survive, the poor endure. The lesson is structural, not moral. Every long-term financial commitment is a bet. Know what you're betting on. Maintain liquidity. Diversify. Keep options open. Distinguish between consumption and survival. And remember, the rules can change overnight, even in the most stable of worlds. Awareness is the only shield that lasts.